Finovasta. Finance. Innovation. Wealth.
If you've ever watched financial news and felt like they were speaking some alien language, you are absolutely in the right place. Today, we are going to completely demystify the stock market. We're taking all that confusing jargon, the intimidating charts, and those rapid-fire ticker symbols, and we're going to break them down into a clear, structured, and highly visual plan. By the end of this, you'll have a rock-solid understanding of what the market actually is and exactly how it functions. Okay, let's dive into this. Here is our zooming out framework. First, the micro, where we'll cover our basics. Second, the marketplace, looking at the mechanics. Third, the macro, understanding the broader environment. And fourth, the personal, focusing entirely on your own strategy.
All right, part one, the micro, the basics. Before we even think about trading strategies, we've got to ask what actually makes up this market. Well, a stock is simply an ownership interest in a company. When you buy a stock, you aren't just buying some blinking ticker symbol on your phone. You're buying a fractional piece of a real, living, breathing business. You literally become a shareholder. And that means you are parting with your hard-earned money for a tiny slice of that company's future economic performance.
And this brilliantly illustrates what that fraction looks like in practice. Let's take a fictional company from our source material called Finovasta Technologies. Say Finovasta has 1 million shares outstanding in total. If you go out and buy 1,000 of those shares, you literally own 0.1% of the entire company. Now, your actual economic rights might shift depending on how the shares are structured, but at its core, you are a partial owner of that business. Pretty cool, right?
So we know why you'd buy them, but why on earth do companies sell them? Well, companies need capital to operate, to build new products, and to hire people. Now, sure, they could just march down to a bank and take out a massive loan, but loans come with incredibly strict, burdensome repayment schedules, not to mention the interest. Selling shares lets a company raise equity capital. They get the cash they need to grow, and in exchange, they give up a small percentage of their ownership. It's basically a way to fund expansion without the crushing pressure of traditional debt.
Moving right along to part two, the marketplace, the mechanics.
So now that we know what a stock actually is, where do these shares live? Enter the stock exchange. Think of this as an organized marketplace where securities are bought and sold under very strictly established rules. You're probably familiar with the heavy hitters, the New York Stock Exchange, or NYSE, and the NASDAQ. These exchanges act as highly regulated arenas where buyers and sellers can safely meet. A company will choose to list its shares on a specific exchange based on its location, who it wants to attract, and various listing requirements.
But how do those shares actually get onto the exchange? And who are you buying them from? There's a really vital distinction here. In the primary market, a private company offers its shares to the public for the very first time. We call this an initial public offering, or IPO. This is the moment the company actually receives the cash. But the secondary market, that is where almost all the action happens. When you tap buy on your brokerage app, you are almost never buying shares directly from the company itself. You're in the secondary market buying existing shares from another investor who just decided to sell. This constant swapping back and forth is what provides liquidity to the whole system.
Let's look at how we measure a company's size in this marketplace. We use something called market capitalization, or market cap. Imagine a company called ABC Technologies. They have 10 million shares outstanding, and right now investors are trading those shares in the secondary market for $20 each. Multiply 10 million shares by a $20 share price, and you get a market capitalization of $200 million. But let's say some great news comes out, and suddenly buyers are willing to pay $25 a share. Boom, that market cap jumps to $250 million. The number of shares didn't change at all, but the perceived value of the company absolutely did.
So how do you actually get in on this? It's highly practical and boils down to 5 concrete steps. First, open a regulated brokerage account, and definitely pay attention to their fees and trading functionality. Second, deposit your money. Third, and honestly the most important, research the investment. Look at the company's profitability, their debt, their competitive position. Fourth, place your order. You'll typically use either a market order to buy immediately or a limit order to set the maximum price you're willing to pay. And finally, step 5, actively monitor your investment to make sure it still lines up with your original strategy.
All right, on to part 3, the macro, the environment. Okay, so we know how individual stocks work and how to buy them, but what about the larger forces at play? Trying to watch thousands of individual companies would be practically impossible, which is exactly why we have the stock market index. An index, like the famous S&P 500 or the Dow Jones Industrial Average, measures the performance of a selected group of stocks.
It serves as a benchmark. So instead of obsessing over one company's daily chart, investors use indices to gauge the broader health and direction of a specific market segment or even the economy as a whole. So the crucial point is, what actually causes those indices and the stock prices within them to constantly go up and down? Well, the immediate answer is pretty simple: supply and demand. If more people want to buy than sell, the price goes up. Simple as that. But the deeper answer involves a mix of underlying forces. It's driven by company performance, things like earnings and revenue growth. It's driven by economic conditions, especially interest rates, because when borrowing gets expensive, it seriously impacts corporate profits. And finally, it's driven by investor expectations and pure market sentiment. Believe it or not, sometimes optimism or fear can move the market way more than actual data.
Now, when that sentiment sustains itself over a long period, we get specific market environments. A bull market is characterized by prolonged rising prices, strong economic expectations, and widespread optimism. Basically, everyone feels great. On the flip side, a bear market is a sustained decline in stock prices accompanied by weakening confidence and economic concerns. And listen, here is the most important thing to remember. Bear markets are completely normal. They're just a standard part of the investing cycle and absolutely not a sign that the entire concept of long-term investing has somehow failed.
Furthermore, it's so important to realize that not every drop is a bear market. Short-term market volatility and price corrections are entirely normal. A highly volatile market will see prices bounce up and down rapidly over just a few days. A correction, on the other hand, is generally a significant decline from a recent high, maybe triggered by geopolitical news or valuation concerns. It is vital to anchor yourself to reality here. A correction does not automatically mean a long-term bear market has begun. Don't let the hype or the panic sway you.
Which brings us to our final section, Part 4, the personal, the strategy.
We've covered the what, the where, and the why. Now, let's focus entirely on you. How should you strategize, grow, and most importantly, protect your money? Well, let's start with the fun part, making money. There are two primary ways investors potentially earn returns. The first is capital appreciation. If you buy a stock for $50 and later sell it for $70, you've made a gross gain of $20 per share. You bought low, you sold high. The second way is through dividends. Some companies actually choose to distribute a portion of their profits directly back to shareholders. So, if you own 100 shares of a company and they pay a $1 dividend per share, you receive $100 in cash, literally just for holding the stock.
Now, what's really interesting about this slide is the stark difference in risk. Take a look at Portfolio A. 100% of the money is invested in one single company. If that company hits a major roadblock, the entire portfolio is devastated. That is what we call extreme concentration risk. Now look at Portfolio B, which utilizes diversification. The money here is spread out across hundreds of different companies, sectors, and regions. Portfolio B might still dip if the whole market goes down, sure, but one single company's bankruptcy isn't going to wipe out the investor. Diversification doesn't eliminate risk completely, but it acts as a really crucial shield. Your strategy also dictates your daily behavior, and it is absolutely vital to establish a clear difference between long-term investing and short-term trading. Long-term investors are looking at business fundamentals. They want slow, steady growth and the magical power of compounding over years or even decades. Traders, on the other hand, focus on short-term price movements, technical analysis, and trying to time the market over a matter of days or even hours. Active trading carries substantial and very different risks. You really need to know which camp you fall into before you put your money on the line.
And regardless of which path you choose, there are definitely landmines to watch out for. Let's do a rapid-fire rundown of the most common beginner mistakes. Number 1, investing without a clear plan or goal. Number 2, panic selling the second the market dips, basically treating a red day on Wall Street like a 5-alarm fire. Number 3, ignoring the fees and taxes that will quietly eat away at your returns. Number 4, blindly following viral social media hype instead of doing real actual research. And number 5, investing money you actually need in the near term. If you need cash for rent next month, it has absolutely no business being exposed to stock market volatility.
The source material for today's explainer summarizes this entire philosophy beautifully with this quote: "Learn first, invest with a plan, stay diversified, think long-term." Honestly, a boring, methodical, and clear financial plan will almost always beat the stress of chasing hyped-up, short-term market movements. Remember, sustainable wealth creation is a marathon, not a sprint.
As we wrap up this explainer, I want to leave you with a question to reflect on. We know the stock market offers incredible growth potential, but it also carries very real risk. So don't just ask if the stock market is simply good or bad. Ask yourself, based on your time frame, your emergency savings, and your own personal risk tolerance, how much stock market exposure is appropriate for your individual financial plan. Take the knowledge you've gained today, apply it to your own life, and empower yourself to build the future you want. Thanks so much for learning with me today.